virtual roundtable. This week's topic, we're going to be discussing the current economic environment and exploring some strategies to move forward in a down market. I'm Jody Skenesny, and I'm the Vice President of Member Engagement at the MICPA, and I'm really happy that you could all join us this afternoon. We have just a powerhouse panel here today, and I'm excited that you're going to get to hear from the three gentlemen who are going to be our presenters and then answering some questions for you guys a little bit later. Just some housekeeping notes. If you've participated in our virtual roundtables in the past, you know how this works. We're going to do it the same way. We have currently more than 50 people participating on this call. So we're going to keep everyone muted. If you have a question, we just ask that you, if you touch your screen, you'll see the little chat function. And if you type your question into that chat, I will kind of serve as the moderator. I'll read the question off to our panelists and they'll be able to answer it that way. We're going to start off with our presenters sharing some information, doing a little bit of a presentation for you, and then we'll open it up to those questions in the chat. So now I do want to introduce our all-star panel here. Like I said, we've got some great experts on the call today, starting off with Mark Rogers. Mark is the Executive Director and Institutional Consulting Director for Morgan Stanley. He's worked in the investment and financial consulting industry since 1985. He was recognized by Forbes on their list of America's Best In-State Wealth Advisors in both 2018 and 2019. We also have Leon Lebrecht, who is the Chief Growth Officer for Sequoia Financial Group. Leon also featured in Forbes, as well as Reuters, CNBC, and a host of other places as an expert. He's a practicing attorney, CPA, CFP, and CFA. He's also a member of the MICPA Board of Directors since 2016. He specializes in financial planning, estate planning, tax law and preparation, tax strategy, a whole host of other things, Michigan economy, and he considers himself, he's a self-proclaimed nerd about this stuff, so we're always really happy when Leon can join us. And then rounding out our group, we have Wayne Titus, founding member of AMDG Financial, an accredited investment fiduciary analyst. Wayne utilizes his responsibilities as a fiduciary to integrate tax, financial, and investment strategies for entrepreneurs and families. So very happy to welcome our panel.
Thank you. Thanks for that opportunity to be here, and I feel very privileged and flattered to be on such a strong panel. So thanks for giving us this opportunity. My background, just so you know where I'm coming from, is from a more institutional perspective. We manage money for college endowments, community foundations, family offices, and then I have a business unit that focuses on retail. So we're in that space quite substantially. But frankly, most of that retail business comes from the investment committee members on each of the institutional accounts that we manage. So just so you understand where I'm coming from, I thought I'd kick it off today just with a little bit of a background of how we got to where we are. And I'm not referring to the pandemic because I'm not thinking in terms of biotechnology right now, but just the markets. And I think it's instructive to recognize that in the fourth quarter, we had a substantial problem with repurchase agreements. And we've been talking about this for quite a while where, and I won't get into that, that could frankly be an entire webinar in and of itself, but the bottom line is that repurchase agreements had a failure. And you can think of a repurchase agreement, which is a super short-term security, as the lubricant to an economic engine. It really keeps everything moving smoothly. And if you have a lockup with that smoothing of the economy, then you're going to seize up and then you're going to have a problem. So the Fed addressed it the way they should have, which was simply by printing money. And when you print money, and we've seen this with 3 other installations called quantitative easing, there's been QE 1, 2, and 3 that were more of a function of what happened in 2008. But I was referring to this as quantitative easing 4, where the market was starting to rise simply because they printed money, and they needed to put liquidity into the system so that banks had liquidity available to them to take care of business. Well, that was the reason the market rose in the fourth quarter of 19. It was also the reason the market rose toward the third week of February in 2020. And then we had the reason to have a recession. The underpinnings of the market rise were very uncertain. Now, I can tell you that at that time, there was no reason really to think in terms of a market crash, because the Fed had already said that they were going to print money through the end of April and then recheck to see if they had to continue to print money. And I would have bet, without a pandemic, without a coordinated effort in the decline of the price of oil, and I'll get into that in a minute, we probably would have taken a pause and given the Fed an excuse to print more money. And that would have kept the market rising. I don't know that we would have had an all-time record high this year, but we would have been in a stable environment into the election, because the Fed did not want to create an outcome on who won the election. They didn't want this to be a bear market for the benefit of the Democratic side, and they didn't want to necessarily give us a huge bull market to support Trump to get him reelected based on the economy. So they were going to try to moderate that. Now bring into this a new variable. And there were two. One's very well known, and it's the reason we're all sitting on Zoom right now, and that's the pandemic. But then the other is the coordinated decline in the price of oil between Saudi Arabia and Russia. And that decline in the price of oil alone could have caused the market to go down. But when you took that situation and layered on top of it a pandemic, now you have the recipe for the market to effectively crash, go into a bear market. We then subsequently went into technically a bull market. And now we're in this period of uncertainty because we don't know how the price of oil is going to play out. And let me point out there, with the price of oil creates a lot of credit risks in the economy. Banks have lent money to a lot of shale producers and fracking companies, and that are going to go out of business. And so that's going to create a real problem in our economy just because of the price of oil. And I learned in business school, we all know this. The cure for low prices are low prices. The playbook is you bring the price down, drive out all the competitors, and then eventually bring the price back up. And I would bet, and I'm not a forecaster, Leanne and Wayne and I were talking about this before we got on the webinar, but if I think about the price of oil, I'm willing to bet that we'll be paying $4 or $5 a gallon at the pump in a few years. And that's simply because we're driving out many of the competitors, and you're going to see MLPs, and you're going to see fracking companies go out of business. And so there's going to be fewer competitors keeping that price down. And so as a result, I would expect the price of oil to rise. Now throw on the uncertainty created from this pandemic. And the markets have already shown that they're going to ebb and flow with the range of fear and greed with investor sentiment. And so I would expect that for quite a while. And we're going to have to really figure out a way to navigate the volatility that will be part of our world until we get a vaccine. I think there'll be periods of time where we have optimism. And I think there'll be periods of times of disappointment. And I'm going to let Leon speak to that because he's done some work on it based on prior pandemics. So maybe this is a good time for Leon to take over.
Great. Thanks, Wayne. And agree with you fully on your comments about oil. We've been watching it. I didn't think the U.S. was going to become part of OPEC. It's just kind of wild that we're now apparently a de facto member of OPEC. I will take a stab at doing some predictions because that's one of my jobs, is to think about the future. There are a couple things I want to hit on today with everybody, and then I'm going to flip it over to Wayne to talk about some of the really cool things that have come through on the CARES Act. First of all, we are in uncharted territory. We have not had a pandemic before, but there are certain things that we've done, and I'm doing a research project right now, going back and looking at the last 100 years and what things have happened. So I'm looking at the U.S. economy coming off of certain giant inflection points, and I'm going to talk about one in particular, and that's 1917. Talk about that in a moment. Also, the inflection points of World War II. I'm going to talk about it from a couple of different multinational levels because I'm looking at it from what happened after World War II in Germany, Japan, and the United States. I also have some data I've been looking at in terms of what's happened in Africa after other pandemics as well. To get it started, though, there's things I've never seen. Most of you know, a lot of you know me, and I've been around a long time. Started at Anderson way back in the 70s, and then to Plant Moran, and then at Walsh College, and so on and so forth, where I was the department chair of the Department of Economics and Finance. So a lot of you are former students, former colleagues, and I know all of you. I count all of you as my friends. I've never seen a bull market and a bear market in 1 month. That's something I've never seen. I don't know, Mark, I don't think you've ever seen it either. I have never seen so much volatility in the market since 2008. And I have never seen ever $2.25 trillion get released in 3 days and completely upend the unemployment law, the SBA law, the tax code, and basically the Fed's system of doing things. So we are in unprecedented, uncharted times. I'm going to suggest one of the first things I want to cover is letters. And what we're trying to figure out is the letter shape of this recovery. I am confident, and we are confident at Sequoia, that we're going to see a recovery. We just don't know. The question is when and what does it look like? All of us would like the much vaunted V-shaped recovery. I would love to have a V, which is it goes down and it comes back up. My level of skepticism is that I think the ingredients for a V are twofold. First ingredient is we need some kind of reduction in the treatment facility so that the fatality rate goes down. I agree with Mark that we're not going to really have full success and full recovery until we have some kind of a vaccine. All the scientists are telling the vaccine is much farther off. However, as the pandemic starts getting to a point where we can start applying the math to a treatment, it makes huge difference. News came out today on a little bit of that possibility of a treatment. Been talking to some people at the Cleveland Clinic, and they tell me there are 19 antivirals they are testing. And if we can take the fatality rate down dramatically, we'll see that. Also in today's news, we saw the USS Teddy Roosevelt had 600 members of its crew actually had the virus. And we don't know the numerator of the number of people in the United States who've actually had the virus and are carrying the virus. That's going to have a difference now that we get some more big data. So a V-shaped recovery is predicated on the fact that A, the fiscal stimulus works, and B, we have some kind of a treatment that slows down the infection vector. The infection vector does appear to be slowing, so all this sequestration does appear to be working. However, it doesn't say it's going to continue to work if we go back out of it. The second shape of the letter we should think about is a U. A U is a downturn in the economy, and I'm predicting, not too scientifically, but probably correctly, we're going to have the worst quarter in U.S. GDP history coming up in this quarter. No question in my mind, worst unemployment we've ever had, short of maybe the Great Depression and maybe even worse, and then the worst decline in GDP. I saw the Chinese numbers today, and they are now negative for the first time in basically 20 years. So actually, first time since 1976, since Mao. So the U-shaped recovery, as we go down, we stay down and come back out. That would be a 2007 to 2008 type recovery, or a 1973 to 1975 type recovery. In my humble opinion, that's probably the more logical thing that happens, that we stay down for a while. And I will suggest, and I'll ask Wayne and Mark this, I think our consumption habits are going to dramatically change. I think that'll mean that different sectors of the economy and different things will do things differently. I'm wondering how many of us are going to like working at home. And I'm also wondering if all of you want to go out to dinner for every single day as soon as we can get back, because I can't wait to get back to a restaurant. I'm dying to get back to a restaurant. The W shape is a reinfection vector. And that would be like a 1981, 1980, where we go down and we pop back up and we go down again. I think that's completely possible. The last but not least is the dreaded L. I'm not going to comment on that one. That means we don't ever cure this disease and we have problems. What I do want to share, though, is something that really concerns me. And I want to go back to some other pandemics. I'm going to share my screen if you don't mind. And this is just something interesting that as CPAs we can all relate to. This is the highest marginal income tax rate in the United States. And those of us who know our history know that we had an income tax in Civil War, which was unconstitutional. But then in 1913, we reactivated the rate basically in around below 10%. In 1917, we had a pandemic, and it was the Spanish flu pandemic. We also were in the middle of World War I, and if you went to the University of Detroit, like I did, there was a monument in the middle of it called the Monument to the Great War, because they thought that was the end of all wars. They didn't call it World War I because they figured out we were never going to have one. Again, they were wrong by only 30 years. But the idea behind that is we were in the middle of a highly destructive war, and we were in the middle of a pandemic. And watch this. 1916, tax rates 15%. 1917, tax rates 63%, jumping up to 75%. Tax rates increasing. Quick math, sports fans. If we go out and we have a pandemic and we put $5 trillion into the economy, who pays for it? Now let's go back and we go through the roaring 20s when we had a nice economic expansion, and we get to 1929 and tax rates bump down, and then we're followed by the Great Depression. Which, by the way, somebody thought in the Great Depression it was a great idea to raise tax rates again, which I will suggest, by the way, will be part of the psyche of the consumer coming out of this pandemic. Now let's go to 1945. U.S. economy is flourishing in 1945. We are putting everything in the war effort. GDP purchasing power is off the chart. highest productivity in the world. Unemployment's at an all-time low because everybody's off in our grandfathers and our dads. My dad was off in World War II over in Germany. Tax rate 94%. 94%. So, in fact, I should probably use the virtual reality part of Zoom to give this appropriate. There's the Dragon Castle from Game of Thrones. It looks to me, my humble opinion, is that we're going to see a dramatic change in tax rates. And I'll respectfully submit that the estate tax rates, which are scheduled to go off and expire in 2025, will probably expire sooner. It was already in the works. My friends at Ways and Means were telling me they were trying to get it into 2023 expiration. I do want to cover one more thing, and that is that the 75/20 rates hit an all-time low ever in history this month. We're now sitting at 0.8, and it's time to look at GRATs. It's time to look at the use of a GRAT or a CLT or interfamily loans. You're going to have a down market, and I'm highly convinced we're going to see the estate tax be the first to go. We'll probably see the income tax on the upper echelon raised again, and then we're going to probably see something like a national sales tax or something else. But do the math with me, CPAs. If I double the tax rate in the United States, I can't pay for the stimulus I just put in. I can't pay for it. Okay? So on my pickings and what we've got to do, we've got to go take a look at all the things we can do with a down market and a down bracket, and I suggest also a down tax rate. So at that, I'm going to flip it to my friend Wayne, who's got some great ideas on what to do in a down market, like Roth conversions or tax loss harvesting or those kinds of things. So Wayne, and by the way, everybody should look at Wayne's book. Wayne has a great book on what entrepreneurs should do in financial planning. I like it, and I'm going to get him to sign the copy if I ever get to see Wayne again, and if I ever get to have lunch with Wayne in person instead of virtually. So Wayne,
I might be able to sign it virtually, Leon.
that'd be great. That'd be great, Wayne. Thanks.
Thanks.
And I'm going to go back to something a little bit more positive. So I'm going to go to my next job. So.
Well, let me just say a couple things on the CARES Act, because I think first off, when we talk about tax law changes, you know, a lot of times those are CPA full employment acts, right? And the CARES Act is a CPA/attorney full employment act. You know, I think as a profession, we're in a unique position. Number one, many of us are business owners. So we have our own issues that we have to deal with the pandemic. And we have clients that are business owners in all walks of life whose, you know, business as usual ended up becoming, how am I going to stay in business? And as CPAs, we're in that unique position to be able to help them through this process. You know, we have to obviously look after our own businesses, but we also need to be helping our clients kind of work through this. The CARES Act was over 868 pages of legislation. We've done some live casts that are recorded and are on my website on the CARES Act. We focused on businesses initially, then individuals, and we just did one on Wednesday that was just focused on unemployment and the benefits for the unemployed, the self-employed, the contractors, the gig workers, and so forth. There's so many people out there that don't think that they're eligible or don't have any idea how the unemployment system works in the United States because they've never had to use it. And I think as CPAs, we're in that unique position to help them do that. All through, you know, just trying to go through these pages of the CARES Act, we have great opportunities if you're in the financial field and you're working with your clients in financial planning or investing. You know, you're probably looking at doing Roth conversions. We started doing Roth conversions a number of years ago when the tax law changed. The drop in the market was an immediate opportunity, and thankfully it happened, you know, at the beginning of the year, so we could plan towards this. Of course, we don't know if the market's going to go down any further, so there's still opportunity, I think, to do conversions. But to do Roth conversions, because you can, if you're moving shares in kind, the same asset classes, if you've got aggressive asset classes and you're able to move them over to the Roth, then you're going to have that springing value all sheltered from tax. So you've got a unique situation. So no matter, Leon, what the bottom of the market is, whether it's a W or a V or the U, you have an opportunity to move many more shares over for the same tax costs that you might have planned on converting anyway. So you have sheltered more future gain. The next thing is tax loss harvesting, taking advantage of moving into similar asset classes. Now remember, you can't do exactly the same unless you're going to, you know, manage the wash loss sale rules. You have to be careful of that. But taking advantage of tax loss harvesting, sheltering those losses for use against future gains. And then finally, rebalancing portfolios, rebalancing that risk. We don't prognosticate on where the market's going to go. It's just going to do what it's going to do. Our markets are efficient. They're going to take ready information and adjust that price almost immediately. And so what we're doing is we're always looking at where are we today and saying, do we need to rebalance portfolios? And taking advantage of where are we and redistributing that risk. So I think as professionals, it's important to understand there's a lot of opportunity to serve our clients and help them interpret things instead of being the, do as I say kind of advisor, instead of being the informative advisor that says, here's all the information, you make the decision. I think as leaders in our profession, we need to be the interpretive advisors. We need to help our clients understand and make the best decisions that they can with the information that we have vetted for them.
So Wayne, let me ask you a question if you don't mind.
The next step into just talking about how we've approached portfolio construction, and this is not only applicable today, but was applicable and necessary ahead of the volatility that we experienced in March and even are going to continue to experience going forward. But when you think about investing money and structure, and not necessarily recommending investments here, but thinking about structure, a couple of things come to mind, and that have worked very well for all of our clients, both institutional as well as retail. If you think in terms of a three-pool approach, where you're separating the money that's invested in different pools based on the time with which you have to keep it invested, it certainly is going to enable you to tolerate the inherent volatility of the market. And so what we've done, and you think in terms of an MICPA. I mean, that's a reality for me. So you think about, they have a cash withdrawal requirement, and that money had to be sitting on the shelf. So you think about pool one being in cash and cash equivalents for maybe the next 1 to 3 year period of time. And then pool two is a little longer time horizon, but not necessarily very long, because it might be investable for 4 to 7 years. And then you might have a third pool, which is long-term growth, that's 7 years. And if we're talking about a college endowment, into perpetuity. So by allocating capital properly into each pool, it enables you to have the staying power in the market that's required for the volatility that we're experiencing today. And so I think on one hand, when you think about markets going up or down, literally going up 10% in one day, you can't time that. How foolish would it feel if we got out of the market and then missed a 10% recovery on a Wednesday? So that is the proof statement that market timing could really come back to haunt you. So the point is that if you have enough money sitting on the shelf to take care of the next few years, and I would submit to you that that probably is long enough to get us through to a vaccine where things will, it may be a new normal, but they're going to normalize. And then you have calibrated your risk tolerance and risk units to the time horizon for the use of that capital. That's going to protect you and put you in a position where you can take advantage of some of the opportunities, even the opportunities that Wayne and Leanne have commented on already, but also putting yourself in a position where you don't have to sell a share of stock. And to this point, we haven't sold a single share of stock for any of our clients. We certainly have taken advantage of rebalancing, tax loss harvesting. And the other structure that I might mention, because there are some positives going backstopping a lot of risk units right now, there's reason to be comfortable for the long term with investing in equities. It's going to be a bumpy ride, but there's a reason to be there, because if you can look across the valley, as Leon mentioned, there's going to be a better opportunity to have gains down the road. And that's one of the advantages that Wayne outlined in moving money into a Roth. You want to make sure that those gains are in a very tax advantaged position as in a Roth. So by moving money now and then taking advantage of the growth that we will see at some point, it's better to have that located in a Roth than in a traditional. But when I think about other structures, because I'm not going to recommend individual investments, I don't know you, or nor do I know your investment policies. But when you think about mutual funds versus separately managed accounts for taxable clients, this is a great opportunity if you have a loss in a mutual fund to move that money from a mutual fund into a separately managed account, because there are some great efficiencies that are available from a tax planning as well as just investment management perspective that really weren't available. There's a number of new SMAs that are out in the markets in the last 2 years that frankly just weren't available 5 years ago. So there's a lot of investors that are sitting with very tax unfriendly mutual fund structures that might be better off in an SMA. I might also mention this concept of active versus passive. You know, I've been an advocate of both depending on where the wind is blowing. And if the wind is at my back, I want to use passive. I want to capture all of the returns of the market, and I want that beta that's available in the market. But right now, I don't want to put a big fish net into the ocean and capture everything that can be collected in that net. I want active management very specifically because I want investment managers that have the ability to identify which companies are going to actually survive, number one. And number two, not only survive, but perhaps flourish because some of their competitors are not going to survive. So it's that kind of thinking that on the equity side of the market, you know, we like the concept of active right now. We'll go back to passive, but it's not yet. And this is not the time for that in our judgment. On the fixed income side, I mentioned SMAs for equities. It's just the opposite for fixed income. We like the concept of mutual funds right now in fixed income because along the capital structure, we're going to need to diversify amongst corporate, high yield, mortgage backed, and we're going to need very, very skillful investment managers that have the ability to diversify a portfolio amongst all those structures and then move the maturities and the duration of the portfolio based on what's happening in our market. So if you're looking at repositioning money because, to Wayne's point, you want a tax loss harvest and you want to take advantage of some of the opportunity set that's available as a result of what's changed now, you know, I would think about those things and determine if that affects your portfolio or makes sense for your own investment policy. So let me hit the pause button. I've got a couple of investment ideas, but I'll come back to that later. Maybe I can throw it over to Leon right now.
Thanks. Great points, Mark. And I agree with you on the active right now. And definitely, we've been doing tax loss harvesting like Wayne too. We've been doing lots of swaps. We are not out of the market. In fact, we've pretty much not left any positions out except a client who's just gotten too nervous and cold feet. But we clearly have been doing swaps and watching that wash sale rule. I did an article in Forbes this week. If you want to grab it, it's up on Forbes.com on tax loss harvesting. Got a nice chart so you can use how to get her out of that substantially identical stuff. So go grab, if you get a chance, Google Forbes, Leon Lebrecht. Did have one really important thing, Ed Doyle, and wanted to know what, with the government's insatiable desire for revenue, what keeps them from going after Roth IRAs? And my answer to you, Ed, is they probably will start going after Roth IRAs. My benefit of being a professional nerd is that I get to talk about stuff that I sort of know about. And under a previous president who was impeached, but not the current one, I was on a committee talking about Roth IRAs when they were first introducing them. And I remember two things distinctly, one of which I will regret for the end of my days, but luckily almost everybody in that meeting is now retired. The first was they said, this is going to be great for poor people. And I said, you guys are dumb. I said, poor people aren't going to use Roth IRAs. They don't have any money. That's why they're poor. This is going to be used by rich people, and we're going to figure out ways to get around it. And hence we've got backdoor Roths and mega Roths and all this other stuff that we can go do. And of course, I think all of us would agree Roths are used more predominantly by higher income people because, you know, lower income people want to save the taxes on their 401k plan. The second thing is the thing I rue the day I said, and they said, well, you know, what if we want it, isn't this going to cost us a whole bunch of money? We're going to get the taxes up front because people put the money in the Roth. But if this accumulates like you financial guys think it's going to do, how do we get the money on that? And I said, well, you can't income tax it backwards because that's against the Constitution. So you can't go backwards and do it. You can only do it to the date of a bill, and you'd have to do it in a sequestration bill and blah, blah, blah. Then I said the stupidest thing I've ever said in my life. I said, all you have to do is pass a value-added tax. If you pass a consumption tax, if I take money out of my Roth, you'll tax it. And they went, oh, and somebody wrote it down. And I would say, it isn't out of my rainbow to say we're going to see something called a COVID sales tax. Now, out of all the developed countries in the world, out of the G20, 19 of them have a sales tax and have something out there. Go look at Canada. Go look at anywhere. Doesn't matter. Just go anywhere in the G20, except us, and you're going to find some kind of a national sales tax. And they could tax consumption, and the consumption goes into the revenue stream. But this is just a really simple one. Just go look at the national budget right now and tell me what the sales stream is from individual income taxes, corporate income taxes, and I just am smelling the tax increase. And they'll find ways to get our Roth taxed, and they'll find ways to tax us in other ways, and we're going to have to come up with ways around it. The only thing beneficial that I can think of is if they do pass the national sales tax, Kim Kardashian will pay a whole bunch of sales tax. So that'll be okay with me. Wayne, you want to pop on Roths? Because I know you and I both agree. I think Mark does too. I know Mark does. Tell us a little bit more about the Roth conversion. I'm really interested because the suspension of the RMD in the CARES Act has given a gigantic opportunity for people who take RMDs, both inherited IRAs and regular IRAs. You want to hit on that?
Well, I mean, the Secure Act obviously is impacted, and we collaborated on that article in Forbes, is going to impact, the distribution from your IRA for your beneficiaries. And so, I think our goal as tax advisors is to minimize and mitigate the impact of taxes, not just obviously for the end of the year, but for the next 20 to 40 years for our clients. And so we have to look out 20 to 40 years. And when you start to talk about what's going to happen with the tax law, 2026, I would think rates are going to go up. Maybe they'll go up before then. As you said, maybe they'll put a national sales tax on. Maybe there'll be another surtax on capital gains. But we have a very small window right now on Roth conversions, at least as we were planning it, through the end of 2025, getting the conversions done at much lower tax rates than we are likely to see. If Congress does nothing, the rates are going to go back up to what they were in 2017. And as we're all anticipating, it's likely that the tax rates are going to have to go up even more to try to help pay for this big support package that we just processed. So for sure, Roth conversions, there's no better time to do that than right now. And when you think about it, getting to the top of the 24% bracket, or even to the top of the 33% bracket, for many taxpayers, 33% is pretty high up there. But why not move up into those upper brackets and get that Roth converted now and get so many more shares moved over there while the markets are down? This is absolutely the time to be doing that. Even if the market goes down any further, we don't know if that's going to be the case. But if you just shave off 20, you can put 20% more of your value of the number of shares in to your Roth now than you could, in mid-February. So why wouldn't you do that now?
Wayne, talk about the RMD suspension under CARES, because folks don't have to take the RMD this year. Doesn't that give you some room right there to do Roth conversion money? It gives you money to make the conversions?
Absolutely. I mean, the RMD suspension provides the opportunity to take additional conversion. If you've been going to that point where you're going to take Social Security, you're thinking about retiring and taking Social Security, if you can continue to push that off to age 70, that creates room. I mean, anywhere where you can create room and push more shares into Roth, you've got to take advantage of that.
Wayne, do you want to speak to the actual payment of the tax on the Roth conversion, where you're sourcing the capital to pay the tax?
Yeah, so you have to be careful about that. Obviously, if you're under 59.5 and you're doing the conversion, you don't want to pay the tax out of the conversion because out of your IRA, because you're going to pay a penalty on that, right? So you have to be careful where you're sourcing that tax income or the ability to pay that tax from. The interesting thing is the CARES Act does have some things that we're looking at from a tax planning perspective. You can take $100,000 out of your IRA accounts now, and if you put it back in the day before the end of the third year, you're not going to pay tax on the fact that you took it out 3 years ago. They're going to treat it just like it was a rollover. So that's a potential source to pay the tax on the conversion now. And it gives you 3 years to save it back, in essence, to gain it back and put it back into the account with no tax implication whatsoever. So, there's some great opportunities out there to take advantage of doing that conversion and paying that tax now, and still not having to worry about paying tax on a distribution if you can roll it back in there.
Hey, Wayne, we modeled that, and you're right. The $100,000 exclusion makes a giant difference. You could use a withdrawal. You could use a withdrawal to pay the taxes on the Roth conversion, then put it back in 3 years.
Absolutely.
And I've always been, up until 2 weeks ago, I said, always pay it out of outside money. But I ran a model and it works in certain cases. You're actually paying it with money that is non-taxable if you put it back in. So you could
Yeah.
get some market gains. Amazing different times. I mean, the amount of things that have changed since the end of 2019 on IRAs. We have the repeal of the stretch. We have, the probability of doing more Roths. We now have this pandemic. We've got the new rules coming out of CARES. I mean, a whole new world now. A whole bunch of things we all have to look at, I think.
I think the other thing to look at too is if you've got some folks that are in retirement, potentially they're in a lower bracket. You could continue to do Roth conversions, but the other thing you could think about is taking that money out of their IRA and bracket topping, just like you would with a Roth conversion. So there's the potential to do some bracket topping. I think, although I don't know, Leon, if you've seen any additional guidance on this, but from a tax perspective, you're going to basically pay that tax. You can elect to pay the tax over 3 years. What I haven't seen is how are they going to treat that as far as income? Is it going to be split a third, and a third? Or are they going to take it all in 1 year and then have you amend your prior return but elect to pay the tax later? I don't exactly know that we have any guidance on that. Have you seen anything?
I have not. I read the rules, which say the years are 2020, 21, and 22. It appears from the committee reports that I've read, because I, like you, read the act, that you have until the end of that third year, the end of 2022. I think the way they're going to do it right now in the default, the way I'm reading the committee report, is intended to be 2022. If you don't pay it if you don't pay it in the other years, it's there. I wanted to bring up an interesting thing, and this is just for the rest of us nerdlings out there. We now have the NOL rules put back, and we also have the ELL limitations removed. So I, like a lot of us, have clients who have closely held businesses and pass-throughs that are having horrendous losses. I mean, think of anybody in a restaurant business, and they're having horrendous losses, and we're pretty much projecting they're going to have horrendous losses. So obviously, we're going to capitalize on the NOL carrybacks, and that's important. But this ELL limitation makes a great opportunity too, Wayne. I'm seeing somebody right now that I'm almost certain are going to lose a significant amount of money this year. In fact, they're going to go right past the ELL limitation. They go, what am I going to do with that? I said, we're going to make lemonade out of the lemons. You're going to convert your 401k, which is $1 million, into a Roth, and it's going to cost us nothing because we're going to use your ELL to offset it. So remember that the subchapter S and pass-through losses now are back. They suspended that rule along with the interest rule, and they suspended the NOL rules. So that's important. Hey, Wayne, Rodney asked a question. You could take that one. If you took part of your RMD in January, can you put it back into the Roth account? And I'll let you take it. I know the answer to that. But.
Yeah, if it's within 60 days, yes.
But Rodney says it's January, so the answer is he's going to have to use that $100,000 if he wants to.
Yeah.
I asked Ways and Means whether they're going to make it retroactive, and right now they're too busy doing other stuff like trying to figure out how to put more money in the PPP, which I wish they would do.
Now, there's circumstances where they say you've got 60 days to do that, and now they're a little lighter on that 60-day rollover, but I wouldn't count on that.
Yeah, I do it in the 60 days. If it's past the 60 days, you're stuck using the $100,000. Now,
right.
The $100,000 effectively is like a rollover, so it's
exactly,
but not the same thing. It's not the same benefit. It is important, Wayne. I think everybody listening should know. Inherited IRAs have the suspension too. There's a suspension on that, and undesignated beneficiaries like estates get an extra year. You just count as if 2020 never happened. So just a couple of more things in there.
And the other thing that just came through, obviously, is the extension. We had the extension for the first quarter to July 15th. We've got the extension now for the second quarter. Those dates are now going to be the same, July 15th.
Yeah.
But there's also the extensions on payments into or contributions into IRA accounts and HSA accounts. So if you haven't seen that guidance, make sure you have that too, because you have a little bit more time to still take advantage of those things if you weren't planning on doing that now because of where things sit.
Yeah, you could put your contributory IRA for 2019 in by July 15th. And
Correct.
You could still do your 2020. I've been telling people, look, if you want to give your kids something, give them an IRA right now. Give them a Roth. Go set up a contributory Roth for them. I did it for my kids. So I took each of my kids, and instead of giving them a normal gift, I just set up their 2019. I already did their 2019 Roths, but I did their 2020 Roths. And I'm telling clients, look, go set up 2019 and 2020 Roths for your kids.
Yeah, if
Let
you
me
have the
touch
money,
on
get it in
the
the market.
question that Kurt had in the chat room. If clients are largely in retirement funds, 401k and Roth, and a W shape leading to say 2 to 3 years, I'm just reading, for markets to come back, should we be shifting alternate hedged positions to more US equities in order to take advantage of market return? And that's a good point. That brings up a couple of ideas that are worth discussing. On one hand, this is probably one of the better times to think about the difference between top-down investment management versus what's known as bottom-up. Bottom-up investment management is basically curating a portfolio one company at a time and identifying the winners from the losers and trying to project whether or not certain companies are going to gain a terrific advantage as a result of what's happening in the current market. I would strongly suggest that you think about bottom-up now more than ever, because the idea of trying to identify whether or not US small cap or US mid or large is going to do better than international, what have you, that's a very difficult game to play in the best of markets. The safest way to navigate these types of markets, in my experience, and this is only my 35th year, but I've been around long enough, the best way to do that, in my judgment, is to really think about companies. And it's not any different than what Warren Buffett does, but there are a number of very, very solid investment managers that have the ability to look around the globe, and they don't care where the company is located. And if there's a company that they can identify that's domiciled in Singapore or in Wixom, Michigan, or in France, if that company is taking advantage of a market opportunity and you can project that there is going to be terrific cash flows as a business going forward, that's probably something to think about owning. So I would argue that that's probably more important to think about from an investment strategy perspective than trying to decide if money should be brought over to the US versus international on a top line basis. On the other hand, there's always room for diversification. And I would strongly recommend that you stay diversified. And if you're a retirement plan fiduciary, I don't know if any of you are fiduciaries of retirement plans, but one thing that we've been doing, and we have quite a large number of clients that are retirement plans, we've been doing webinars for those participants. This is a great opportunity if you're a fiduciary to show leadership and educate your participants, which number one is an important thing for your fiduciary liability. But then secondly, it's a great opportunity for you to create goodwill with your employee base, because it gives you the opportunity to connect them to good thinking in a very difficult time. So those are just two things that I thought of when I read Kurt's very good question here as far as the markets are concerned. And I think that, and I don't know if Wayne and Leon agree with my thinking on bottom up versus top down, but I've always felt that it's difficult to forecast whether or not a particular market is going to outperform another. I've always felt more confident in feeling that if we own good companies, regardless of where they're located, the odds are we're going to make money over a market cycle. And I really don't see today being any different than any other time. In fact, I think that there's a great opportunity for, and I mentioned, and I think Leon echoed that, a great opportunity for active managers to sift through the rubble and say, I'm going to own that company. No, I don't want that one. This company took advantage of their revolver, so they're well capitalized, so I want that one. This company looks like it's going to fail, so as a result, I want this one. That's the kind of thinking that I think makes sense when you're in a crisis market. And that's what we're in right now. And whether it's a W, whether it's Leon's thinking of a U, we don't know. But what we do know is that we are going to get a vaccine. We know we're going to get back to a normal. We know that markets are going to be better a couple, 3 years from now. And my experience, every time I look back at market crises, whether it was the crash in '87, whether it was a dot-com bubble burst or '08, anytime I bought stocks and I had the courage to buy companies at these depressed prices, it didn't feel good. It scared me, and you have to have courage. But literally 3-4 years later, you were so glad that you had the courage to do that. And now it's just obvious. Now you have to do that to protect capital for the future and make money for the future. So that's just my 2 cents on making money in a very, very volatile market. I don't think it's over. I think we're going to go through a lot of false starts. We're going to have hope from Gilead today, and then eventually investor sentiment's going to wane, and we're going to lose hope for a minute, and the markets are going to reflect that, and then we're going to gain hope. And as we track forward, keep in mind one thing: we don't have to have the vaccine before the market stabilizes. The markets are very forward-thinking machines, and they're going to give us stability in the market before we have a vaccine. That's certain. That's the way markets work. They're forward-thinking. So you have to be forward-thinking as an investor as well, and position yourself, after you make these great tax changes and take advantage of the estate planning ideas with the GRATs that Leanne commented on. At the end of the day, we have to make good decisions with our money. And regardless of which structure and what account we have the money located in, we have to make very reasonable decisions with that money. And then lastly, and I'll kick it over to Leanne in a moment here, the question there was whether or not we get away from hedged investments to more of a full experience market volatility investment strategy. And I would say we might be early there. I would say that there's room for a portion of the portfolio to be completely exposed to the inherent volatility of the market. But I think that it's too early, unless you're really an aggressive investor, to get over your skis with your risk units right now. And I think that if you walk slowly, I think you'll be rewarded. And even having cash, which is a terrible investment, and in this period of reflation that we're in right now, cash is going to be horrible. Fixed income is going to be horrible. But that doesn't mean it's horrible today. And so I would walk slowly, abandoning those safe harbors, because we're going to need them along the way to balance portfolios and give us the level of standard deviation that's acceptable per the investment policy that we're playing toward. So with that, Leanne, maybe you want to build on that.
I couldn't agree with you more on active and on the bottom-up approach. Our stock portfolios, we run a stock portfolio plus mutual funds. We've been looking for companies that we call YARP, yield at a reasonable price. And so we're looking for companies with good, solid balance sheets, lots of cash, decent dividends. Those are companies out there. And there are going to be winners and losers. This is definitely evolution in its heyday. And, Darwin didn't say it's survival of the strongest. Darwin said it's survival of the most adaptable. And who's the most adaptable companies out there? And you mentioned Berkshire. We're buying Berkshire. It's in our portfolio. We've been buying Berkshire. So it's one of those things of, hey, it's on sale, and there's a company that's got plenty of cash and does have a long-term strategic approach, and it's a good way to go. So I think the active approach is solid in there, and there are companies out there that have solid balance sheets. The question we're doing, Mark and Wayne, is that we're just asking the question of what's it going to look like later? Not only what companies are going to win. So I mean, you can take the airlines, and I think we agree. Someday we're all going to fly again. So there will be a winner airline. Which one's it going to be? Who is it going to be? But then the other end of the scale is what companies are strong enough to diversify this and adapt themselves to whatever the new normal is going into this, whether it's a U, a W, or anything else. We also have not pulled all the hedges off. I was reading about CalPERS. CalPERS in February pulled their biggest market hedge they had. They had the biggest hedge in the world, biggest pension fund in the world, pulled a hedge, and it would have been up 3,600%. They lost $1 billion by pulling their downside protection off their portfolio. They had $22 million long short hedge on it, so it was a long drop short hedge, and it cost them $1 billion. They would have been up $1 billion in their fund by doing that. So Wayne, I'll throw it to you. What do you want to cover on that?
Well, we take mostly a passive approach to things, which doesn't mean you don't do anything, right? But we utilize mostly mutual funds, and we've been looking at ETF strategies. But the interesting thing on the ETF strategies is the spread, the bid-ask spread on a lot of these ETFs. Exactly when you want to do some of these things, that bid-ask spread went way up. So your cost of making those ETF transactions outstripped maybe some of the benefit. So I think you have to be careful on the types of things that you get involved in. The institutional funds that we're using, we hold probably 12 to 15,000 different company stocks, and we do have a focus on profitability. The ARP kind of companies, Leon, that you're looking at, for sure. You've got to do that. We've got more of a tilt to small in value in the portfolios, and so when we rebalanced, we were rebalancing when the markets were down very significantly, and value has been trailing for almost 11 years, and that has that rebalancing has continued to force us to buy value at much lower prices. That hurt us, when the markets dropped because we had significant value positions. But when we rebalanced, we bought more value, which is a little kind of counterintuitive, but we bought significantly more value, and by the end of a week or two later, value was back up and had outstripped and outperformed the U.S. market, large market. So we don't know which asset classes are going to be the leaders and which ones are going to be the losers. And that's not what we're trying to accomplish. We're trying to set that strategy for that client long-term, because we're talking about long-term strategy. If you don't have a long-term strategy, you should not be invested in the market. You should be invested more conservatively. If you have a long-term strategy, you absolutely need to be invested in the market. It's a matter of how much you need to put towards the market exposure and in which asset classes, and then to rebalance portfolios. That's what you've got to do. That gives you the hindsight and the ability then to move that portfolio forward for another 10 or 15 or 20 years.
So as I think about all the things that we're doing with fiscal stimulus and all of the things that are going to impact our world financially from a tax perspective, and you should notice that I very carefully stayed in my lane with investments here. When you work for Greystone, which is a business of Morgan Stanley, you really feel like your employer is a compliance department. So I'm not allowed to speak to tax planning. So I very, very carefully stayed in my lane of investment management. But when you think about what's going on, what the government has done, which frankly I think have been very reasonable decisions given the terribly unreasonable environment we're in, especially as it connects to the pandemic. So far, so good as far as I'm concerned. But if you look forward, this reflationary environment is going to cause an enormous inflation problem. And so I don't think you necessarily have to address it in April of 2020, but you should start thinking about it in April in 2020 and start thinking about what hedges you can put into a portfolio that are going to be beneficial from an inflationary perspective, and whether that's commodities or gold to you. I'm not recommending anything to anybody on this call, but on the other hand, it's worth thinking about and adding those types of allocations to a well-diversified portfolio, even if it's in a small way, because it's pretty clear, just as it's very clear to you from an income tax planning perspective, that we're going to have some changes. It's very clear to me from an investment management perspective that we're also going to face investment changes. And it's more than just passive versus active. It's more than just international versus domestic. It's more than just growth versus value. There are going to be some necessary asset class positions required in a diversified portfolio to navigate some of the obvious outcomes that we're going to face as a result of what the government has done so far. And frankly, we're not done yet. There's going to be more of this. So it's even going to become more compelling. So, just think about that. Maybe think about how that applies to your investment policy. I think Wayne's point about rebalancing and staying disciplined is important. One thing that you should probably do if you haven't already, and we've done this for our clients, but if you do it on your own or however you're managing money, dust off everybody's investment policy. Make sure that you're within target range. We happened to, in mid-March, we sold a treasury bond position that we bought tactically for our clients. And I'm not recommending anybody do anything here, but it's what we did. And as a result, we had a very large infusion of cash. And I will tell you, emotionally, it felt good to sell something at a profit in the middle of March. It also felt good to have cash in the middle of March. Then we looked at everybody's investment policy. And there were a few instances where that harvesting of the gain created a larger than appropriate cash position based on the investment policy. And the investment policy, Wayne mentioned it in his opening comments, an investment policy forces you to do things that don't feel comfortable because you have to, and that's why you have an investment policy. You have a playbook in place that says this is what you have to do, even if your heart and your stomach is telling you you don't want to do it. And 99.9% of the time, if you do that, you're going to make money. You just have to be able to have the courage to do it. And the courage in this case is just following the playbook. You put an investment policy in place for a reason, and then you have to pay attention to it in times of turmoil. And so, suggestion to any of you that are fiduciaries, revisit investment policies, make sure portfolios are within tolerances. And if they aren't, think about how you're going to address them, not only in the old form of investment diversification, but taking into consideration some of the new opportunities that are going to be important too. I'll kick it over to Leon, and then I do have some thoughts on how this whole thing ends, how monetary policy ends. It's not bad. It's going to happen in all of our lifetimes. We're all young enough that we're going to see it. But there are very substantial investment implications connected to the end of monetary policy that we're going to have to wrestle with. Leanne, you want to build on that?
I just think that's a great, I'm interested in your whole perspective on that. I think it's fascinating that we haven't finished unwinding the last QE and we're into the new QE. So one of the questions I'll throw back to you is, is this going to be inflationary eventually or deflationary? And where does this all go? I do agree with you, Mark. We're going to have another round of stimulus. It's absolutely going to be in there. Probably another 250 in the PPP, hopefully today, what I heard. And I'm hearing numbers like 2 trillion. And I think someone in Washington learned to put a T in front of their zeros and add another 3 zeros to everything. So they're now in this new avenue. I'll just leave you with the brave new world. And I want to go back to what you think on monetary policy. This fiscal stimulus is unbelievable. We're going to have to pay for it. This monetary policy is unbelievable. We're going to have to pay for it. So get ready for a new paradigm of how we do things. In the meantime, in the short run, business owners can do a lot of things. The suspension of the NOL rules, the ELL rules, the idea with some of the things Wayne talked about, Roth conversions, GRATs. This is the time, definitely, if there's ever a time in history to look at GRAT and asset transfers, loans between family members. The 75-20 rate's 0.8 right now. So it's time that we have to dust off our hats and get back in the game. This is the time we're needed most. Our job as CPAs is to serve our clients and to help them. And man, if they ever needed us, they need us now. So I'll leave it at that. Tell us
Wayne,
about this, Wayne.
Sorry about that. What's that, Leon?
You got to just your close. I was just going to.
Oh, well, I think, we can't forget, we've got to take a leadership role with our clients. We've got to help them through this process. We've got to help them understand the impact of taxes, not what it is today, but what it's going to be down the road. What can they take advantage of today? We've got to help them with the PPP, assuming we get more funding for that. Is that the right way for the clients to go? Have they gotten their emergency disaster loans? What kind of things can we help our clients with and position them to come out of this, right? And then helping our clients focus on not just what are we going to do to get through this, but how are they going to position their businesses strategically for the change that we're going to see in whether people are working at home, whether they're working in the offices, whether their business paradigms are going to change. They need to start looking strategically down the road. And I think as CPAs, again, we're best positioned to help them do that kind of thing.
We had a couple of questions come over in the chat, and I know that you guys have been great about answering them on the spot, but in case people aren't following along with the chat and may have a similar question, I'd like to kind of go back and answer them out loud too. William asks, would a typical employer 401k plan allow a partial Roth rollover within the employer plan? I'm thinking of a retiree who's left a substantial 401k account with the former employer. Would complete liquidation and roll over to a personal IRA be advised?
Most plans have potentially have the opportunity to allow in-plan conversions, right? And so if there is an in-plan conversion, you can take advantage of that. Again, I think you have to be careful, because if you're below 59.5, you do that in-plan conversion, you got to pay tax out of your pocket, because if you pay for it in conversion, you're going to have a penalty on that. So you have to be very careful about what are the tax implications of doing a conversion and where you're going to fund that tax liability.
And then Rodney had asked, what Berkshire Hathaway are you buying? What about BRKB?
I did answer that already on the chat. So
okay.
we're buying the B. Only the largest of the clients, the elephants, can buy the A. Mark, I do want to hear one last thing from you on that monetary policy. I'd love to hear your comments on it.
Sure. Jody, are you done?
That's all we've got in the chat right now. So
Okay.
Unless we see more questions pop up, go right ahead.
So, and this is, let me just flash, this is not Greystone Morgan Stanley. This is Mark Rogers. As I think about sovereign debt versus corporate debt, different rules apply, different strategies apply. And as I think about the mountain of debt that we're creating as a country and try to project how things are going to look from an investment landscape down the road, I can't help but think about the primary lever that is likely to be used is the devaluation of our currency. And that will solve problems. It's inflationary. It's going to solve problems. And it's going to be a problem, especially for investors that are a little overweighted in fixed income and overweighted in cash, because we're not going to see it, but we're going to feel it. The loss of earnings, or excuse me, purchasing power on our fixed income and cash investments. So while I don't think it's necessary to adjust portfolios to this thinking today, as we walk through this process, and as I already mentioned, we're going to see a lot of ebb and flow. We have to start thinking about equities. We have to start thinking about gold, and we have to start thinking about real estate. And we have to start thinking about what are we going to lose from a purchasing power perspective if we overweight our portfolios to fixed income and cash, especially domestically, because that's the playbook. I mean, that's to be expected. And I'm not necessarily making adjustments today with clients, but I'm definitely talking about it today. And the people that I think terrible for, I don't worry about our institutional clients. I don't worry about our family offices. I do worry about my 85-year-old mom, who I've got to say, Ma, I can't keep your money in CDs anymore. I can't keep your money in cash. I've got to start putting you in dividend-paying stocks to protect not just you, but also our family. And so that's a very difficult conversation, because we're all used to moving into a more defensive position as we age. And if we do that with too much of a percentage of the portfolio for our older clients, we're going to walk them right into a buzzsaw. And that's going to happen. It's just a matter of when it's going to start and to manifest itself. And we have to be just like these structures where I talked about the pool 1, 2, and 3. That had to be installed before middle of March. And that enables you to get through the inherent volatility of the market. Well, you have to start thinking about the outcome of a devaluation of your currency before it happens, so that you're not in the position where you're the most vulnerable and at risk of losing purchasing power. So that's my current thinking on where we are today versus where we're likely to head. But I would suggest that you read and study and think about sovereign debt and the tools that a sovereign will use versus a corporation. And we all know the corporate toolbox. You guys live it every day, but we're talking about a different toolbox, and it's something that you have to think about, because it's nothing to fear. It's reality. You just have to adjust to it and recognize that it's coming. And if you do that ahead of time, then you're going to protect your capital, your client's capital, and if you're a fiduciary, make sure that you're thinking in those thoughts as well, as far as how do we make sure that I'm not just playing this as business as usual, because it will not be business as usual.
Great. If I'm not seeing any more questions come over on chat. So at this point, unless you guys have any parting words of wisdom, then we will go ahead and wrap up. But before we do, I of course want to thank our panelists again for participating. Thank all of you who are able to be on this roundtable today for participating, because we know that you are not just looking out for your own families, but your clients as well. And so we appreciate you taking the time to learn everything that you can to help advise your clients through these interesting times. We will be continuing these roundtable discussions, hopefully on a weekly basis, basically until you guys stop wanting to participate. Next week, we have lined up Craig Vanderberg from Tryon Solutions. He's the Chief Operating Officer at Tryon Solutions. He's going to be talking about HR implications in the wake of the coronavirus, everything from your remote work policies to if how to advise your clients in looking at either layoffs or furloughs and kind of everything in between there. So lots of great information coming next Thursday from noon to 1:30. Keep an eye on your e-news and your email box because that's where you'll find the link for next week's discussion. So once again, I want to thank Wayne and Mark and Leon for participating today, for being, as Leon likes to put it, the nerds that we turn to for this kind of information. Very much appreciated. And to all of you, as always, if you have any questions or concerns, the MICPA is here to help. We're just either a phone call or a quick click and a chat away. So happy to be here to help answer any problems or questions you may have. Also, make sure that you are checking out MICPA Connect. Lots of great discussions happening there amongst our members as well. So with that, everybody stay safe, and we'll look forward to hopefully seeing you on the call next Thursday.
Thanks, everyone.
Thank you, everybody.
Thanks, everybody.